My name's Simon Clements, and I'm the lead fund manager on the Sustainable Future Global Growth Fund, which I'm going to talk to you about for about 20 minutes now. So the team at Liontrust, on the first slide here, we're a 13-strong team. The team was actually started by Peter McAllis, who's the head of the team, and also my boss, in 2001. So we are one of the longest running teams around. I've been on the team 11 years, and I've been running the Sustainable Future Global Growth Fund as the lead manager now for 10 years on the 30th of November. So we're coming up to my 10-year anniversary with the fund. In terms of the way we structure our team, we have what we call an integrated approach. And what Simon was just talking about on his last slide, that was point 3. So what that effectively means is what we don't do is we don't separate the decision-making process within our team from people who are looking at the sustainability attributes of a company and those who are looking at the kind of fundamental, traditional kind of fund management kind of aspects of a company. These are all done by the same person. And what that means is that effectively everybody in the team is an analyst. I'm an analyst. Peter, who heads the team, is an analyst. So we all have analytical responsibilities, pardon me. So yeah, so it's a 13-strong team, and you know, as I say, it's an integrated approach, and we think, you know, that this is done, sustainable investing is done in various different ways, and this is the way we think works best. We're you know, as I say, we're very, very experienced. We've got nearly 20 years of doing this sort of thing. And the reason we think it's so effective to have this integrated approach is because we think if you have a separate team who decides whether something goes in the portfolio, who are separate to those people who are looking at the kind of sustainability attributes of a company, we believe that the person choosing whether a company goes into the fund or not misses out some really valuable information. And really, we kind of, you know, fundamentally believe that more sustainable companies make better quality companies. Okay, there's 49 stocks in this global portfolio. You know, we want to make sure we have the best 49 companies possible in the fund. And having that information, you know, the sustainability attributes of a business alongside the traditional business fundamental and valuation aspects is really, really important to assess the true underlying kind of quality of a business. So if we move on, this is the fund performance. As I say, it's 10 years in November since I've been running the fund. And you know, one of our kind of, you know, when we set up these funds, you know, the idea was to deliver performance which you know, outperform mainstream peers and mainstream benchmarks. Okay, because we believe that investing sustainability leads to better returns. These are better quality companies, and we're investing behind kind of trends within the global economy that the global economy is moving towards. So really kind of think about, you know, the economy of the future is how we invest. So, you know, we're really proud to deliver some great performance over the last 10 years for our clients. I'm now going to just talk a little bit about our process and how we approach this. You can kind of just about see that. So really there's 4 stages you know, to our process, and every single company in our portfolio has to satisfy 4 key criteria. And I'm going to talk about these in a bit more detail in a moment. So I'll just introduce them for now. So the first aspect is thematic analysis, and we're thematic investors, and what we mean by thematic investing is we believe that our themes track structural changes in the global economy tied to the idea that over time economies become more sustainable, and we believe that they do become more sustainable, and this is a trend that we can observe and we can invest behind. And I'm going to talk a little bit more about what those themes are, and really that's kind of the starting point, you know, to what we do. So aligning our portfolio with these structural changes, these themes within the global economy tied to the idea of sustainability. The second aspect is we believe we will only invest in sustainable companies, and we believe that sustainable companies make better investments. So if you think of the thematic analysis as like a top-down picture of the global economy and aligning our portfolio with those changes, the step 2 is really bottom-up analysis of company X, is or isn't it a sustainable company in its own right. And I'm going to talk a little bit about the tools and how we approach that in a moment. But the second aspect really is, you know, we only invest in sustainable companies, you know, in their own right. The third aspect is once we've gone through stages 1 and 2, we really get to what our assessment of the business fundamentals. And stage 1 and 2 really narrow down our universe to this kind of smaller kind of selection of what we consider more sustainable companies. And what we do here is we almost forget about the fact that these companies are, a terrific kind of a terrific kind of impacts and make terrific impacts, and from a sustainability point of view, they're fantastic, because if they're not great businesses, if they're not a great investment, it doesn't belong in our portfolio. And this has been, in our experience, doing this for 2 decades, I think that where sustainable investing had fallen down in the past is that too many fund managers have forgotten to put enough weight on the fact that only great businesses belong in their portfolios. Okay, so and I'm going to talk a little bit about, I'll introduce what we think about in a business, what we look for, within what we consider, a very strong business from a fundamental perspective. And the last aspect is valuation. So, and the kind of the way we think about that is that it doesn't matter how great a business is from a sustainability, from a fundamental perspective, if it's not undervalued, in our opinion, it's not going to outperform. Now, what we don't mean by this is we're not going to go out and search for low multiple stocks per se. Okay, most of the portfolios most of the stocks in our portfolio, would probably be rated on premiums to the market, and that's fine, because we value the business on a minimum 5-year view based on what we think the business is going to deliver. Okay, and I'll talk a little bit about that in a moment. So every stock in the portfolio, every company in the portfolio has to satisfy these 4 filters, and if they don't, they won't make it into the portfolio. So I'm just going to begin with that stage 1, which is the thematic analysis. Excuse me. So when we think about our themes, our themes really, if we look at the global economy, for instance, we don't necessarily believe that there's going to be particularly strong economic growth in the next decade. There certainly hasn't been in the last decade. But what that masks to us is that economies are dynamic. So there's parts of the global economy that will be growing rapidly over the next decade and the decade after that, and there's parts that are shrinking. Okay, what we're trying to do with our themes is align our portfolio to areas of the global economy growing rapidly, driven by the idea that economies become more sustainable over time. And that is a core belief of what we do. We believe over time economies become more sustainable. And we believe they become more sustainable in 3 key ways. I'm just going to drop this down a little bit. So 3 key ways to become more sustainable that we can invest behind, that align our portfolio with this rapid growth. Okay, the first is that they become more efficient over time. And the kind of the justification for this is quite simple. So there's more and more people in the global economy. There's a set and often dwindling resource base. We need to do more with less. Okay, we need to do materially more with less. So the first group of themes come under this banner of resource efficiency, a more efficient global economy, and we believe that over time we can observe that. The second thesis that we have, where we deliver our themes, is that over time economies need to improve health. They need to deliver a better quality of life for people within them. Okay, that's why we all participate in an economy, because it improves our life. And here the themes, you can see what they relate to. Things like access to healthcare, innovation in healthcare, serving unmet medical needs, providing education for our children, healthier lifestyles. So the second area, the thesis that we invest behind is this idea that over time economies need to improve health and improve your standard of living. The third aspect the third kind of key thesis where we have themes that we invest behind is the kind of thesis that over time economies need to become safer and more resilient. Economies need to be able to better absorb shocks over time. And that relates, our themes there relate to things like a more resilient financial sector, but also, things like safer roads. We think safer roads is something we can observe over time that we can invest behind. A safer online world, in enhancing digital security. And really, when you think about what, when you're investing behind this kind of change, we're investing behind change in the global economy, tied to the idea that it becomes more sustainable. And we believe that the reason that the economy becomes more sustainable is there's really three key drivers. Okay, so the first is that consumer and people demand change. You know, it's a change in preference. You know, we've seen it with things like tobacco. We're seeing it at the moment with things like, you know, attitudes towards unhealthy food or attitudes towards plastic. You also have them alongside this kind of this change in consumer preference and demand. You have governments that regulate to get you towards this outcome. So that's the second force. And the third force is that you have the private sector within a capitalist society that innovates and basically provides innovative solutions to deliver this change. And really, that's what we're investing behind. We've observed these changes that are happening, and we're finding ways to invest behind it, you know, with these 20 themes. Okay, so that's the starting point. The next area that we look at is, you know, related to, you know, the idea of, you know, only invest sustainable companies belong in our portfolio. And, you know, as Simon's, you know, discussed earlier, whether a company is or isn't sustainable, you know, can be quite subjective. And it does, you know, it takes, you know, you've got to have kind of tools and you've got to have a process by which you approach it. Okay. As I say, we've been doing this for, you know, nearly 20 years. We have analysts on the team that have been there more than 15 years. And, you know, we feel that we have a process that's kind of, you know, proven the test of time, as it were. So we really, the kind of key to whether something is or isn't sustainable, in our opinion, is this sustainability matrix. And really, we approach every business according to kind of two criteria. First of all, what they do, the product rating, and we give that a rank of between A and E. And anything rated with a product rating of A is something whereby the product or service they provide has huge benefits to society and the environment, to, you know, society as a whole, with very little cost. Okay, you can see examples there, things like thermal insulation, you know, Thermo Fisher with life science technologies, kind of, you know, life-saving medicines or helping to supply life-saving medicines. Anything that's rated an E on the other side of the spectrum is where their costs to society far outweigh any benefits that they bring from a sustainability point of view. And what we mean by that is, again, environmental impact, social costs. So think of an E as, you know, a tobacco company. You know, a tobacco company with very little, you know, benefits to society with huge costs. You know, it kills its customers, huge costs, you know, on the healthcare system. And so we'll only invest from a product point of view in anything rated A, Bs, or Cs. So Cs are neutral. There's very few of them in the portfolio, but we can invest in Cs. But what we then do is we look at the management rating as well. So, you know, how do they run their business? Here we look at traditional management metrics, but also we place more emphasis on environmental, social, and governance impacts. You know, so. And we'll change this weighting according to what the business is. So, for instance, with a financial services company, the environmental impact is probably reasonably minimal. But what's really important is things like, you know, sales culture within the organization. You know, do they get the right products to the right people? Governance. You know, net promoter scores is something really important. Whereas for an industrial company, it might be different. It might be safety record. You know, environmental impact will be more important. And we'll give that company a rating between 1 and 5. And we only invest in companies rated A's, B's, or C's. We can never invest in a 5. And if it's C, it has to be rated above a 3. And that's really how we approach it. We also, you know, we use, you know, MSCI Sustainalytics as external providers, but really, you know, we use those as an input into our process. So the analysts will take that as an input, and they'll also kind of do their own analysis as well. The third stage, again, is looking at, you know, business fundamentals. And here, you know, what we're looking for really is kind of 3 aspects. So first of all, we're looking for companies that are growing, you know, structural tailwinds, structural growth drivers, you know, driven by our themes, and also companies kind of gaining share. So, you know, growing within a growth market. We're also looking for companies with, you know, high returns. So barriers to entry, high return businesses, avoiding companies that grow but don't actually create any value as they grow. And the last is, you know, quality. When we look at quality, we think like things like recurring revenues and high free cash flow conversion. So here again, we're looking for, you know, great businesses in their own right. We forget about the fact that they're kind of saving the world, as it were. The final aspect is valuation, and here what we do is we look out with the turnover of the portfolio is 20%. So we look out 5 years when we make an initial investment. We forecast out what we think the company can deliver from a revenue perspective. We then do work on the margins, and then we come up with what we think is an earnings power 5 years out, and we then will assign what we feel is the appropriate multiple, and it has to have more than 10% per annum upside when we initially invest. So it has to be undervalued when we initially invest in it, and that becomes the pin by which we have a sell discipline, that kind of long-term valuation. I've got a quick example of a company. So Autodesk, which is in the portfolio. So Autodesk fits the theme of improving industrial and agricultural processes, and this is what we like, because it serves an industry which is effectively very inefficient, construction. So when you think about how things are handled from a construction perspective, traditionally it's a very inefficient process. It's an industry that's been unable to basically improve their productivity because they haven't been able to adopt technology properly. And the graphs here indicate that, showing that construction lags behind the total economy from a productivity perspective, and also how tasks are handled. More than half tasks are handled by pen and paper, and a third by spreadsheets. So it's a very inefficient way of doing things, and it's something that's kind of ripe. The errors are ripe. According to the trade body in the UK, the average large-scale construction project has errors leading to $43 million worth of costs. Okay, so Autodesk basically has a technology which helps address that. So what they do is they're bringing technology related to things like cloud computing, data analytics, and really bringing it onto large-scale construction projects. And it's really kind of revolutionary technology, and it's increasingly being adopted across the board. So this is what BIM is. It's building information management. It's really bringing that technology onto a building site. So, I mean, typically in construction, you have problems because they have what you call component silos. So, you have the architect has the design, and then it's taken down on bits of paper, and then the electrician comes in and does something, and somebody's putting up a steel, the steel does something else, and they don't quite match. So you have all these errors, you have huge, cost overruns, have huge material wastage. What this technology does is effectively now on large scale construction projects, often you'll see people with iPads, and they'll be able to collaborate through what different people are doing. And if something's changed down on the site, then it gets fed back to the people who have designed the project. It's much more efficient. You can see here the graph on the left, what this kind of technology does. So it reduces conflicts, better communication, less errors, reduced costs, and reduced rework. And you can see on the right, this is really important in terms of the adoption of BIM. So this is what we're investing behind. Even the 3D design, 3D is effectively where you digitalize the process. Even the 3D design is only 50% penetrated. And you go along to different types of BIM, 4D where you include timing of when things happen, 5D is when you bring in costing, and 6D is where you can actually include things like facilities management. So you're doing more and more real-time information, as the project's being, as something's being built, as the projects are being run. And you can see what we love, Autodesk, it has a 57% market share, by far the biggest player in the BIM market, globally. And on the right, something really interesting. So the fact Autodesk software is the second most pirated software in the world after Adobe. So they have 18 million active users, only actually 6 million of them actually pay for it. So there's 12 million non-compliant users. So you have this really exciting kind of growth angle as the product gets adopted, but also as you kind of sell into an active user base. Many of them don't know that they're non-compliant because they're buying it through resellers on the internet, often outside of the Western world. So you add it all together. Let's remember how we think about companies. First of all, the theme. It definitely fits the theme. The sustainability matrix, it's a B1, very good management score. The product's very positive. And from the fundamentals, a great business, 95% recurring revenue, 40% operating margin, 120% free cash flow conversion, and 35% EPS growth. And for that, you pay 30 times 2023 free cash flow per share. We think it can rise 23% per annum to December 2024. So this is a stock which can compound and deliver great performance. I think I've kind of run out of time now, so I'm not going to be able to run you through my second example, which is Intuitive Surgical, but I'll just show you the end portfolio by theme, which I think is really important. So what we like to explain to our clients is what we aren't. We're not, you know, an environmental technology fund. We're not just a biotechnology fund. We're a multi-thematic investor, and you can see here, you can see how the portfolio, this is the end portfolio by theme and also by the largest holdings. So you can see it's well spread across different themes, across different parts of the global economy. You think about our themes, they're almost like a thesis around the kind of incremental change from a sustainability perspective that we can invest behind. With that, I think that I'll conclude and hand back to Simon.